everybody. Reporting to you again from the Glamour City, Hollywood.
They don't want to all of a sudden be in the own a power plant business. And so almost all of our jobs are delivered through power purchase agreements and not through CapEx. Because if we can finance it and we can get competitive financing and we can walk in with just a fixed flat rate, that's a much easier model for them to digest. So, we love the slogan, do you know the price of power in 20 years? Because we'll show up and do a 20-year fixed rate take or pay contract. So that's for 20 years, that rate is locked in. And I have customers who locked in their rates, with us 10 years ago right now, or 9 years ago, that are sitting there looking at this energy crisis and seeing power rates go up by 90%, saying, good thing we locked it in. And so the tipping point tends to be that we can hit, what current par is on the utility for wherever we're at. And in general, if you can not cost additional money, you can be sustainable, easily marketable, and it's a 20-year fixed rate. We see companies taking that like crazy right now.
If you love listening to this show, please consider giving a rating and a review on Amazon Alexa or wherever you listen. We want to continue bringing you this amazing content, and part of our ability to do that means that we need a big audience. Now, it may not seem like much, but rating and reviewing the show will help more people find us, just like how you found this show. Simply on any podcast platform, search for a show, scroll down to the bottom, and push 5 stars. It's that easy. Thanks for supporting the show. Today, I'm joined by Jereme Kent, who is the CEO of One Energy. Welcome to the show today.
Thanks, Scott.
So you have a background in running large wind turbine construction projects, and I wonder if you could tell us a little bit about your experience.
Yeah, so fresh out of school, I accidentally ended up working for the largest wind energy contractor in the United States and probably the world, and was fortunate enough to be part of some of what were at the time the largest wind projects in the country, and to this day are still some of the largest ones that exist in the world. So that's where I got started, and have kind of migrated from there.
Now, I got to believe that over the years, you've probably seen quite a bit of change, both in business models, but also the turbine fundamental technology. So I wonder if you could give us a quick recap.
Yeah, so I think I started in this 15 or so years ago when the industry was just getting going. I think you've obviously seen turbines get bigger. You've seen people trying to figure out how much more they can max out blades. We were really excited when we were building 83 meter diameter rotors back in the day. So it's 83 meters from end to end. People are now building 160 meter diameters, literally double the length and 4 times the area. So the scale of what's happening is crazy in terms of size. The core 3 blades that spin around on a horizontal axis to drive a generator still is the way that almost all turbines are, or at least all the turbines at scale. So the look hasn't changed much, but the scale of what we're talking about has changed substantially. And I think you've also seen, ironically, wind turbine installers in the utility scale industry having to answer for being good, safe companies that maybe 15 or 16 years ago wasn't the first question asked by a potential owner.
Now, at the time of this recording, just in the media, there was coverage of Nordic countries that have just signed a large pact. I think it's in excess of over 100 plus millions of dollars, where it's going to be an offshore wind farm that's going to generate clean energy for a lot of the Nordic countries. And again, this is, I think, we'll talk a little bit about it, but it's a bit of a reaction to the current war in Ukraine, for instance. What do you think about that? And more importantly, as we transition to talk about the energy grid, and specifically in the US and some of the challenges like in the South, I think Texas is having issues with the ability to generate enough electricity to supply the demand that's outstripping it, for example.
So, Scott, I don't know how old you are, but I'm 37. And in my entire lifetime, this is the biggest energy crisis the world has ever seen. We're only just starting to understand the magnitude of how big this crisis is going to be right now. But you have fundamental problems in the way the power grid works. You have natural gas at record high pricing. Henry Hub price was back above 820 this morning. When you talk about what that's doing to, every country, every community, every power grid, from ERCOT in Texas to PJM in the Northeast to, every country in the EU, everybody's trying to figure out what they're going to do. And you're seeing Nordic countries, as well as other European countries, continue to look for where they can capture more, fixed rate energy. So, sure, wind is renewable, solar is renewable. More importantly, it has free fuel. So there's no war that makes the price of wind more expensive tomorrow. And so I think you're going to see more countries looking at that. You're seeing the US look more at that. But this is an unprecedented time for the amount of change that we're about to see in the power grid. And frankly, for your power bill at home and for every other place that you use liquid or electric energy.
Okay. So again, we're going to table the power grid just a little bit, but then in the context of what we're talking about in terms of the wind aspects, for those large commercial and businesses that are using it for industrial and manufacturing purposes, but they're heavily dependent on the grid, what are the vulnerabilities to their business, critical business aspects, and how does renewables such as this help alleviate some of those issues?
Yeah, so we're seeing two trends. We're seeing one, large manufacturers saying, look, I just want as much behind the meter fixed rate renewable resource as possible because it provides the pure, financial impact of, I know the cost of power for a major portion of my power, whether that's 20% or 80% of that facility's usage. What we're also seeing is this sub trend of, as large industrial facilities look to electrify, they're realizing that the substations they have that were built 50 years ago just won't work. So here's the concept that people struggle with. If you have a 10 megawatt factory and you want to take it to net zero, you need a 30 or 40 megawatt substation because you have to have significantly more renewables than you do for the base load of that plant. And so there isn't a factory out there that built a 40 megawatt substation for a 10 megawatt factory. So we're seeing people invest in their power systems. And when they do that, they're adding in things that get them better resiliency, better control, better ability to shut down different lines and control their load as they see rates spike. And so we're seeing, both the goal of using more and more on-site energy and even looking at on-site storage and other solutions. But at the same time, we're seeing them realize they have to rebuild power systems that were designed for an entirely different world 40 and 50 years ago.
And I think that's a very poignant point, especially as we talk about not just legacy businesses that are trying to mitigate some of these risks, but then new forms of factories. And I think there's a strategic, almost a defense kind of a set of infrastructure bills that's been approved to enhance our construction capabilities as it pertains to semiconductors and manufacturing capabilities that pertains to not just auto, but other aspects, so that we can start to domestically internalize a lot of these things. So when you have things like a gigafactory, part of the design of those new gigafactories is going to have to account for how is it going to be actually power. And to your point, if the base system is X, you need to make sure that the capacity generation is much larger, right?
And I can almost guarantee the gigafactory isn't built that way because nobody's thinking about that yet, and they're just starting to think about it now. Most of the engineering firms you hire to do large factories are still thinking about, how do I serve the usage of the plant? How do I allow for the plant to grow by 25%? No one's thinking about, how do I design a system that makes it easy to do net zero in the future? So, right now it's wind and solar. Maybe you want to add in geothermal. Maybe you want to add in hydrogen, EV charging. You find the right storage. Some of the other tech that claims to be coming out comes out. Maybe if someone finds a unicorn, it turns out they can make, them into a little box and produce infinite power on site that you want. It needs a place to plug in. And it needs a place to plug in and to power that entire facility. And so I think there needs to be a full renaissance in what power system design for large end users looks like, especially if you believe that the distributed power grid is the future, which is something that we're big proponents of.
So again, I think at this point, having gone through decades and decades of transition to this new forms of energy, and certainly decentralization, distributed is what's being taught at schools at this point. But the reality is the CapEx on some of these things is massive, right?
Right.
So first, let's talk about what is One Energy and talk about the business model and how are you guys structuring so that it makes sense for businesses?
Yeah, so we refer to ourselves as a utility 2.0 company. And what we really mean by that is that we are embracing a decentralized grid and we're helping each individual customer do what they want for their private little microgrid. And so our core business for years has been building large wind turbines for large factories. So we're the largest installer and operator of behind the meter wind in the country. But we will also do other things like add in solar to help get to a balanced monthly profile for net zero. We'll build substations, we'll build power systems, but we act like a private utility for large factories. And in our view, that's what creates the opportunity for each individual factory to decide what they want to do. So if you want true net zero, great. If you want super high resiliency, great. If you're in a spot that can't do wind and you want to do other technologies, great. Let's make all that work. But there has to be a company that helps all of that tech actually plug in. And there has to be a company that at 2:00 in the morning on a Sunday shows up with an entire team to get a plant back online. Because until that happens, we're all stuck with utility 1.0 and all the ridiculousness that comes along with that, as John Oliver was so nice to point out this weekend.
So to be clear, what you're saying is that One Energy isn't necessarily just purely focused on wind power, but it's also supporting other forms of renewables. But it's this one-stop shop that provides construction as well as engineering and the design capabilities to actually implement it on site. Is that correct?
Exactly. And the operations in the long run, right? Most large industrial facilities don't want to play with their 138 kV or 34.5 kV power system, right? They're really good at building widgets, and they like to keep building widgets, and they just want a utility who will take care of them and give them what they want from a risk profile. Utilities won't do that, so we step in. So that's what has taken us from what started for the first 7 or 8 years as a pure play wind behind the meter company and got us to expand into more places.
So again, the natural question comes up is, especially in the case of manufacturing. Manufacturing is one of those areas where efficiencies, hyper efficiencies, and productivity, and I think the way they characterize it is you have a finite set of fixed assets, and they want to try and minimize new capex as much as possible and to leverage throughput so that you get more out of what you have with the existing set of infrastructure. So in that kind of a mindset, how are they being receptive to these kind of new capex project that you are bringing? Obviously, it has great benefits, but unless they're in some place like Texas where they're not sure if they're going to have energy, for example, next week, for other places where there's a bit more stability, what's the button? What's the tipping point for them to say yes?
Yeah, so I guess I will first of all just add the caveat that I think right now MISO and PJM are just as bad as Texas, so they're seeing it everywhere, and that's where the whole Rust Belt is. Most of these customers, you're absolutely right. They don't want to all of a sudden be in the own a power plant business, and so almost all of our jobs are delivered through power purchase agreements and not through CapEx. Because if we can finance it and we can get competitive financing and we can walk in with just a fixed flat rate, that's a much easier model for them to digest. So, we love the slogan, do you know the price of power in 20 years? Because we'll show up and do a 20-year fixed rate take or pay contract. So that's for 20 years, that rate is locked in. And I have customers who locked in their rates, with us 10 years ago right now, or 9 years ago, that are sitting there looking at this energy crisis and seeing power rates go up by 90%, saying, good thing we locked it in. And so the tipping point tends to be that we can hit, what current par is on the utility for wherever we're at. And in general, if you can not cost additional money, you can be sustainable, easily marketable, and it's a 20-year fixed rate. We see companies taking that like crazy right now.
Okay, so again, that makes perfect sense. But then the other side of the equation is the capital structure aspects, the cap table, right? Because now you're talking about different forms of debt and equity and other forms of financing to really bring the project together. Right. And in the climate of rising interest rates, what does that mean and what's the implication?
Yeah, so obviously interest rates make costs go up. Right now, what we're seeing in the market for 20-year contracted revenue streams is not nearly as bad as where you're seeing some of the other interest rates moving. So, we are still seeing attractive rates. We're still seeing rates far lower than what we've seen in years. When I first started trying to finance behind the meter wind, 10 plus years ago, we were getting rates in like the 11% range, which is just obscene. We've gotten big enough and gotten scaled down that our all-in fixed rates are, below 4%. And that's still today in today's market. And so, we've gotten good enough that the interest rates can still be absorbed and still be better than what you're seeing for overall inflation in the power grid, because there's nowhere near 90% increase that you're seeing in end rates. But those numbers aren't made up. I have customers whose power bill is 60, 70, 80% higher than it was a year ago, just because of the cost of natural gas and driving LMP. And so, if we go up 10% and the grid goes up 80, it still works out just fine.
Mm-hmm, mm-hmm. Absolutely. Now, of course, in the financing world, the Wall Street sense, and of course, other NGOs that are supporting these financing aspects, there's been a big proponent and growth around green bonds. And that really provides kind of this set of behavioral alignment in terms of making sure that it's aligned to sustainability, ESG-oriented projects. But in return for that, you get a substantially lower interest rate that's in terms of the financing costs. Are you seeing that readily available, and are you guys taking advantage of some of those green bonds?
We are seeing pure play senior debt still outperform green bonds. Oftentimes, green bonds have a lot of ambiguity to them and aren't kind of pure play contracted revenue streams. And so a pure play contracted revenue stream tends to still get better financing. But we are seeing some companies do green bonds and look at trying to use that. They tend to do far better at cleaning up a dirty operation than a pure play clean energy project.
Interesting. Let's talk a little bit about this project called Wind for Industry. What is this?
So Wind for Industry is what we finally decided to call our projects, because one of my frustration points with the Department of Energy for years has been they have a definition of distributed wind that is overly broad and misleading about what the industry is. So the DOE defines distributed wind as any wind turbine connected to the distribution system, either directly to it or on the customer side of the meter. So that means that a 10 megawatt wind farm directly connected to the grid is measured the same as a wind turbine connected to Whirlpool behind the meter. And so we don't like that. And so we clarified that with Wind for Industry, which is a subset of behind the meter megawatt scale distributed wind. And it's far easier to track those statistics, because I don't really care if there's a 20 megawatt project at 34.5 that has nothing to do with the factory. That's not the right comparison for us. It's how are large factories, industrial facilities embracing wind? And so we try to narrow that down a little bit.
Yeah, no, I think that makes perfect sense. Now, are there cases when, depending on the design, that there is actually a surplus? And when there is surplus, is there an opportunity to then sell back? So in other words, for the purchaser of the power purchaser, in this case, the industrial, the manufacturers, is there an opportunity where they're not only having savings, but there's actually cash flow that they can derive from this as well?
So there should be. In most states, that's not legal, is the interesting part. So most states have laws, either through net metering laws or otherwise, that essentially say that you can produce up to your annual usage. So maybe you have a month or two where you're above and a month or two where you're below. But they try to discourage you becoming a power generator, which makes no sense, right? If a large factory wants to also put out distributed energy and charge a fair grid rate for that makes sense, or get paid, LMP, why can't they? Right? The utilities have completely failed at their job. IPPs are charging an obscene amount of money. If a refinery wants to put in wind turbines, then wants to add some more to that to power the community around it, why can't it? So I would love to see that happen. The last time you saw that big push was the last big energy crisis in the 70s, when you saw PURPA come out of it. So I do think that'll be a conversation topic in the next few years as everybody gets tired of these bills.
Yeah. Here's an interesting question, which is both for your entity, but also the kinds of customers that you're working with, is that just because they're doing a certain type of business, let's say manufacturing components for tractors, let's say, but at some point, maybe that business is going to go away for whatever reasons, technology obsolescence, relocation, whatever it is. But in theory, they still have this asset that's generating potential cash flow. Could they recharacterize themselves or create a new entity that becomes a power generator, power operator? And also the question goes for you as well. In addition to service oriented on the CapEx and OpEx or through the power purchase agreements, could you also potentially create microgrid distributed operation as well to sell back to the retail and the downstream?
Yeah, so the concept is called being a qualified facility under PURPA. And under that, either our customers, if they own it, or ourselves, are able to tell the grid that we want to sell to you, even though the factory is not using it, and get paid avoided cost. And so it's a different kind of arrangement and a different kind of interconnection that is mostly paperwork and semantics, but essentially they have to buy the power. Now, they've been attacking that series of laws, and so they've made it harder to do that in the past few years, but it does still exist. And it can still be done. So essentially what happens is the worst case scenario is if that factory shuts down, you become a merchant power generator and you're selling at merchant rates back into the grid, and or you try to go broker your own deal if you don't want to do it with the local utility. So that is always the fail safe. And I think that the more they can expand and make that easier and fairer to do, the better it's going to be to see private investment in behind the meter generation.
Yeah, really interesting indeed. Now, at the current time of this recording, of course, there's an active Russia-Ukraine war that's happening, and we've seen a huge spike in crude oil skyrocket and been very favorable for OPEC nations as well as oil and gas operators profiting very richly. I think Aramco reported was it 20 or 40 billion dollars in just one quarter. This, of course, is affecting energy prices as most are using natural gas, coal, or oil to generate electricity. How are the rising energy costs affecting the demand for renewables? And is this going to be just temporary? And will it potentially continue even after this war?
Yeah. So I think the last 15 years have been spent replacing large coal plants with large natural gas plants all across the country, from Texas to PJM and every place else. All the big investment has been in either renewables or in natural gas plants. And everybody said the price of natural gas is $2, $3, $4. It's never going to go above $4. And so everything's fine. And so take a long-term view on natural gas. It's a good transition fuel, all the stuff you hear. And none of the scenarios had $8 gas in it. So when I'm talking about $8 gas, I'm talking about Henry Hub pricing. That's what we all like to talk about. And so you're seeing, because of the war in Ukraine, because of the fact that in Europe right now, natural gas is $30 or $40, you're seeing this massive demand to try to export more and more gas from the US. You're seeing LNG carriers. There's a whole bunch of LNG forecasted out. So right now, forecasts on Henry Hub show at least a year of chaos. I think that realistically, this is the start of 5 years of chaos. And I think everybody's going to try to figure out how to make up for that. But you can't just undo that and all of a sudden have power cost drop back down again exponentially. You're going to have a huge problem with drillers trying to ramp back up. The industry doesn't change as fast as a war starts or stops. And I think the fundamental assumption of forever cheap natural gas is now about to be challenged for at least 4 or 5 years.
Indeed. Let's talk about the geographies that you guys play in, and then you mentioned the Rust Belt, right? So talk about what's happening on the ground. What are the real realities that these industrials and operators are having to face, and how important is the decision to adopt new forms of renewables for them?
Yeah, and so I think we're getting better at calling it the heartland, not the Rust Belt, although I still tend to say the Rust Belt way too often. But the majority of stuff that we all think of as stuff is made in the Midwest, right? It's made in the heartland. It's made in the, from Iowa over to Ohio, Indiana, Michigan, Illinois, Pennsylvania, old steel mills. You're seeing, the guys who actually make stuff. And to your point, the ingredients are large CapEx for big equipment. Then they have people, raw materials, and energy, right? Those are their 3 big costs. And you're seeing places who had $500,000 a month power bills realize that they're about to start having $1 million a month power bills. And that's one of their big variable costs. And so all they can do is pass that on, right? So you're going to start seeing that continue to drive inflation. And you're seeing, they talk about, 10, 15% inflation. The reality is there's 100% inflation right now in energy. 100% inflation in energy. And so that cost is going to have to flow through manufacturers who have no choice but to pass it on. And the manufacturers who've invested in on-site renewables or who've committed to on-site renewables are bypassing all of that. I mean, I have customers who get 75, 80% of their energy from on-site wind. Their prices haven't changed. I have no mechanism to change their price. And so they now, relative to their competitors who are all seeing the increase, can now be more competitive and or make a premium on top of that as the market flows up. So I think they're all seeing that in their risk profile. There's not a purchasing manager or operations manager in manufacturing right now who isn't having meetings saying, how do we get better control of energy? What can we do? What hedges can we get? And the answer in most cases is you can't do anything.
Well, this is very frustrating, but at the same time, for your company, I mean, it's a real opportunity. And just using a parallelism is that certainly the war in Ukraine also has had a huge uptick in the defense sector. So as the EU countries and some of those both NATO as well as non-NATO countries recognize that they need to arm up, and of course they're looking to the US defense primes and contractors. But the problem is they can't build and deliver those fast enough. So in your case, same thing goes is, even if the demand is there, can you supply fast enough? And what are the methodologies, but also really the constraints around components? Things maybe that, you still have to rely on, like maybe there's microprocessors and microchips and ICs that you're still dependent upon, for instance. How are you going to be able to meet the needs on a large scale?
Yeah, so I mean, we right now have a very much need a bigger boat problem. So we need a bigger boat. We can't respond fast enough for the first time in the history of the company. We went from for the first 11, 12 years figuring out how to get more customers to now we're trying to figure out with all the customers calling, who do we want to help, and who can we help first, and what's the biggest bang for the buck. And so the supply chain absolutely can support it. All the wind turbines that are going to large wind farms can just as easily go behind the meter. You can ramp up. This model does scale to where, when I was running big wind projects early in my career, we were building 3 wind turbines a day, right? And so you can ramp that up. You can get a supply chain that does that. But we need to be a much bigger company to do that. And this is very hard stuff. This is, if you think about kind of the worst business model you could come up with from a complexity point of view, layering in the need to self-perform some of the largest, most complicated construction in the world, dealing with utilities who are some of the most notorious bad actors in the world, helping to steer regulation and write laws in places where there are no laws for behind-the-meter projects, while dealing with Fortune 500 companies who demand the best, while having to deal with tax equity, project finance, and then trying to grow and scale all of that in a complicated time. This is a very challenging model. We've been able to succeed with it, but it's hard for someone to just jump in and do this. So, I do think you're going to see competition in our industry, people trying to do similar things to what we're doing, but it's not a start that business tomorrow type business. It takes a lot of capital to get to where you can actually build, 50 megawatt microgrids.
Well, I think the name of the game is going to be around scale. So it'd be interesting to see how things shape up and the kind of consolidations and M&A that we can anticipate. We've have been joined by Jereme Kent, who is the CEO of One Energy. I want to thank you for joining today.
Scott, thank you for your time.
If you've enjoyed this episode, take a moment to rate our show on any podcast platform that you listen to. Scroll down to the bottom and push 5 stars. It's that easy. And as always, thanks for listening.